It's interesting because there was a report in the Economic Times, Jay, that said, I just read it a couple days ago, that said JPMorgan now holds over 750 million ounces of silver. That's more than $40 billion worth, and would be, if true, the largest stockpile on the planet. It goes on to say that they have not only stopped shorting the market as of recently, but they have completely flipped and become the biggest long in the market. And it said that in 6 weeks, they added 21 million ounces while closing a 200 million ounce short position. This is the 200 million ounces was the pressure that kept the price.
Surfer, like I'm your best friend. Balances in your bank instead. What's up, everybody? Welcome to the show today. I have Andy Schectman, who is the CEO and the owner of Miles Franklin, with us today again. And Andy, I'm glad to have you here. We had a great show a couple weeks ago, and we actually hit over 103,000 views, which is blows away my channel for our average views. And I think it's a testament to just what's going on. People are wanting to better understand the gold and silver market, but they also love hearing from you, Andy, and all the wisdom and knowledge that you have for us.
Appreciate that, Jay. Happy holidays to you and everyone out there, by the way. And it's good to be here, my man.
Happy holidays. So to start off with, Andy, I thought I've got a lot to cover with us today, and we just chatted about a handful of subjects. But to start off, I wanted to talk about this AI channel. Just briefly, I wanted to kind of hit it because a lot of questions are coming up. And I think a lot of people are still trying to figure out if this thing is real or not. And I'm seeing a lot of concern for a silver confiscation. What do you know about this so far? And, what can you share with us?
Yeah, his first video that I watched had something to do with the refiners not taking any new orders because of they hedged if they have a whole bunch of silver in process of being refined, let's say $50 million worth, they will take the opposite side of that on COMEX and hedge their position. And if silver moved up too fast, they would get margin calls. Well, this was good information and true, whereby the refiners would definitely get margin calls when silver was moving up so fast and the metal hadn't been refined yet. They have a problem. They haven't sold the metal to be able to cover their exposure. That was true, but there was stuff within that article, or in that video rather, that wasn't true, talking about how all the dealers were out of product, and if you called Monday morning, there would be nothing, and it was rather sensational. So I kind of got my dauber up into watching what he was saying. Then came the confiscation video that you speak of. Now, first and foremost, when gold was confiscated in 1933, it was largely done because gold was tied to the monetary policy of this country, not about environmental or energy policy. So that's first and foremost, right? So, there's never been a reason to confiscate assets based upon energy or environmental policies. There is no HR 9847 law with mandatory private reporting of strategic metals tied to the infrastructure. In fact, HR 9847 is actually creating Early Childhood Leaders Act, and it's meant to amend the Higher Education Act of 1965. So it isn't even a real law, number one, and it when you talk about what had happened with silver becoming a critical mineral, it was not enacted as law, and it was an executive order. It had never been signed by the president as a law and run through Congress. It was an executive order. And if you look at text within the Federal Register, it doesn't say anything about this. In fact, it says nothing about mandatory reporting by private companies or government acquisition of private reserves. And he goes into this thing and says every order that dealers are accepting now carries a Form 8300. Couldn't be more wrong if he had to be. A Form 8300, Jay, would be if you went to Nordstrom's and bought $11,000 worth of clothes for your family, or went to Golf Galaxy and bought $10,000, anything over 10 grand worth of golf clubs for your whole family, or tried to go buy a new car and paid with cash. The minute you cross $10,000 in any retail capacity in the United States. If you pay with cash, you fill out a Form 8300. Now, cash being green cash, $100 bills, or multiple money orders. And this is done largely from the IRS perspective. You know, if you've been making $100,000, $200,000 a year, whatever the number is, and you try to spend 10 grand, it will just get filed away and they'll overlook it. If you've been slinging weed on the corner for the past 20 years and have no W-2 to speak of, and then try to pay with 10 grand in something, you may get a knock on your door with two guys in a trench coat. So I guess what I'm saying is that there is no Form 8300. You can spend $20 million with me, $100 million, write out a check or send a wire. There is no any reporting whatsoever, including a Form 8300. So a lot of what he's talking about is not correct. And the bottom line is there is no law passed by Congress under House Resolution 9847 or any other number that contains that quoted text about mandatory reporting or acquisitions. The quoted language as well does not appear in the official text of the National Emergency Executive Order or any publicly known available government document. So, as my friend Kevin would say, it's fugazi. And it was, meant to, I think, get a lot of people to subscribe and click on the newsletter. It's clickbait, or on the channel, it's clickbait largely. I wouldn't worry about it myself.
Yeah, so we're just about done with this, guys. This is the channel just to show you. They've had a lot of people subscribe in the last 2 or 3 days, about 6,000 people, and they've had hundreds of thousands of views. So, what I just want to share with you guys, and the reason I wanted to ask Andy about it is, be careful when you're watching things. If you see something that seems drastically different than the status quo, if it's not something that you're hearing on a lot of other channels, and even if you are, always do your research, look into it. I've probably had over a dozen questions from people just in the last 24 hours around the subject. So I wanted to at least address it here because I know it's starting to make its rounds through the community.
Yeah, no, and it's definitely misinformation.
Definitely. Okay, Andy. So now that we got that behind us, a couple other questions people had, and I wanted to read this out to you so that I could, so we could understand a little bit better of what they're asking. But let me just pull it up here real quick. This has to do around this spoofing. So I wanted to make sure that we got a good understanding to people so that they understand how some of the manipulation works, and where that might be able to take the price of gold and silver here. So this is from Sci-Fi Sicko 2390. Ask Andy to explain this. How do the shorts manipulate the market? I don't get how a bunch of future contracts lower than spot have anything like the effect of long holders dumping thousands of contracts at lowball prices. I just watched 5,000 long contracts dump in 5 minutes, bringing the silver price down $2. Isn't this equivalent to about 1/5 of the total shorts JPMorgan were holding at peak short? Also, who is buying? If the buyers of those 25 million dumped ounces stand for delivery, how can that work when it happens at least a dozen times a week? And then he basically asks, who funds this and can it be rigged?
Well, I mean, shorting, this type of naked shorting happens all the time. A lot of times it happens in very thinly traded markets where they'll dump it in the access market overnight and they'll dump paper contracts. You see, what's different now is that no one ever stood for delivery on these exchanges, and so they could paper manipulate it by selling paper contracts at a level that would overwhelm the longs. And they would continue to sell and drive down the paper price until the longs would capitulate and sell. And they would then be able to cover those positions very easily. The banks who had shorted the price, would be able to cover their positions very easily as they had driven down the paper price. Where it gets difficult for them is in now the fact that the people on the other side of the trade have become very wise to what they're doing, and they're standing for delivery. And it doesn't matter how far you push the paper price down when you have people standing for delivery. Said another way, in a market that is based upon trust, right? it works until you have people stand for delivery. Most of my career, which is now almost 36 years, no one ever stood for delivery. When I tell you less than 1% of contracts stood for delivery, I'm dead serious. No one stood for delivery. And now they are. And there's a good portion of the market that is challenging the West. These are countries, sovereign wealth funds and central banks of India and Saudi Arabia and Russia and China, and on, that are now standing for delivery. These countries never had any intention to stand for delivery or challenge the West. They're coordinated now, they're motivated, and they smell blood in the water. But what is interesting is you're now seeing the exact same thing happen here in the United States. And it's interesting because there was a report in the Economic Times, Jay, that said, I just read it a couple days ago, that said JPMorgan now holds over 750 million ounces of silver. That's more than $40 billion worth, and would be, if true, the largest stockpile on the planet. It goes on to say that they have not only stopped shorting the market as of recently, but they have completely flipped and become the biggest long in the market. And it said that in 6 weeks, they added 21 million ounces while closing a 200 million ounce short position. This is the 200 million ounces was the pressure that kept the price low. When you have traders come in odd hours and dump more onto the market, it just suppresses it that much faster and triggers stops. A lot of these longs will be run by algorithms, or hedge funds that run by algorithms. And if a level is breached, it sells. And so they will come in the access market, as we saw a few weeks ago, which is when New York is closed and before it gets to Asia, or in between either Asia and London or US and Asia. It doesn't matter. They are selling it at the most inopportune time, when there is no liquidity in the market, when the traders are asleep, when anyone who was stupid enough to do that would be shot and fired, and probably in that order, in the respect that that's not how you maximize your settlement, your trade. You would do it in the middle of New York trading when the traders are active, and you do it slowly over time. So going back to JPMorgan, they closed out a 200 million ounce paper short, which again is the pressure that is keeping it down. And they added 21 million ounces in physical over that time. The buying pushes prices up. The article went on to say that they also added 16.6 or took 16.6 million ounces out of their registered inventory. In COMEX, there's eligible, there's registered. Eligible, we have 9 COMEX vaults around North America. One is Brinks JFK in New York. That is a COMEX vault. If you have 1,000-ounce bars in our program, as many do, those are eligible. They could be sold. They could be moved into registered. They are eligible to be moved into registered, but they're not. They belong in strong hands, and they're not for sale. Registered are actually the bars that back the contracts. So JPMorgan pulled 16.6 million ounces out of registered inventory, and it left the COMEX. Now that's goodbye. That's never coming back. Once it leaves, it has to be reintroduced into the system, re-registered and assayed. It's never coming back. That would, in my mind, be someone like a Tesla or a Samsung or a Sony. And of course, that same channel talks about Samsung in an effort to get silver for their solid state batteries flying to Mexico, that same AI channel. And that may be true. Again, there is truth in some of what they're saying. But again, you're seeing big players, because look, China, as I've been reporting, has been going to Mexico and to Peru for the last several years, buying doré and concentrate right from the miners in pre-production stage, before it's even called silver, buying it and bringing it back home. What's interesting is Mexico's number 1, China's number 2, and Peru's number 3. So the number 2 producer in the world goes to number 1 and 3, buys doré and concentrate before it's ever even becomes silver. Concentrate is a byproduct sludge of the mining process, and doré are crudely refined bars. Well, they think it's important enough to fly all the way to Central America or South America, buy it in unrefined form, pay double what the West will, ship it back to China to refine it. This is the second largest producer in the world. So going back to what I was saying, they pulled 16.6 million ounces out of registered, and off it goes. It's never coming back. They also did something that I wasn't really familiar with, and it's called they moved 169 million ounces into non-deliverable vaults. To me, that's the same thing as pulling it out of the system. But that means the metal still exists on paper, but they legally removed it from the delivery system. Can't be used for COMEX unless it's re-registered. What you are seeing JPMorgan do is effectively um, removing metal from the delivery pool to get as far away from it as they can. And if it's true, and they are now net long, and the largest short position is now the largest long in the marketplace, this is a very, very, very bullish signal. A couple other things. I talk about how no one ever stood for delivery, right? In the first 12 days of the December delivery, which started the day after Thanksgiving, and you wonder why the server shut down Thanksgiving night, of the 1,000 commodities traded, just happened to shut down on the metals market. The servers overheated because there was obviously a bevy of activity on Thanksgiving night, and the traders left dinner to go lock in orders. No, it was damage control. But in the first 12 days of delivery that we've seen, I haven't looked in the last 2 days, we saw 58 million ounces of silver delivered and 2.85 million ounces of gold, with contracts still being issued all month long that can stand for delivery. But ask yourself, who's got the money to stand for delivery on 58 million ounces? But this is what we've seen every single month for the past 13 months since he won the election. Literally, this is what we've seen on every single month. 2.84 million in gold and 58 million ounces in silver just in 12 days. And of the 12 days, 4 or 5 of them were weekends. So, you're talking 6 or 7, 8 trading days, and you're seeing this kind of volume. Things are beginning to get very, very, very interesting in the market again. You got rising lease rates in London and in the US, all of that stuff. I don't know, man. It's things are beginning to get very interesting in the silver market, and it is because of physical delivery. It is the delivery that is overwhelming the system, and that is what is changing the narrative.
Well, and I think it's interesting too when you're talking about going long too. It's not just having long contracts. It's also acquiring the metals themselves. It's pulling them out of circulation.
Yes.
That's even more telling to me than just going long on contracts. They want it. They know something's coming. So
100%. And at that level, when you see this kind of volume coming in, these people are the most well-informed traders on the planet, not just the most well-funded. And at that level, you're tied into the playbook, and they know what's coming, and they don't spend billions every month, literally billions every month for 13 months unless they have been told this is how you should probably position yourself. At that level, when you're dealing in billions, you're probably tied into the people that make the decisions and know the playbook. And so they don't do things just for shits and giggles. They do it because they know, to your point, what's coming.
They do. So, Andy, before we get to the next question, I wanted to talk a little bit more about the GSR. It's going way down very quickly. And I think some people feel like we're going to get to a really low number very fast. Before we get to that, what I wanted to do is ask another question just in the middle here. So just a quick break. Last week or 2 weeks ago, we talked about the video got cut off kind of at the very end, the last 8 minutes. I don't know what happened, but it broke on us, and I put another video out. But what I wanted to help people understand is the question was, what's the best product to be getting into right now? And the answer that you had at the time was junk silver. And I think you even mentioned Eagles are always a good buy to be into. So one, with all of this action going on in silver, are you still seeing that constitutional or junk silver is the best buy? Are people
no
still
question. In my career, I've never seen anything like it, ever, never. When you're able to buy junk silver below spot, I've never seen anything like it, ever. And it's very difficult for me to even try and contemplate why it's happening. During the pandemic, junk silver would have been between $9 and $13 over spot everywhere in the country for almost 4 years. Pendulums often swing too far to one side and definitely too far to the other side here. I think it is without question the best value period that I've ever seen in silver in 35 years, ever.
So we got junk silver. How about Eagles? Are they still well priced, or are they getting pricier at this time?
No, they are getting pricier, but I think you'll find our prices will be as good or better than anywhere in North America on them. We have sealed boxes of them, backdates that most companies charge more for in sealed boxes. I don't. And you'll get boxes from whenever 2017, 18, 19, 20, 21. It could be 2024. You go to most websites, they charge you more. I charge you less. Um, they're a great value. And again, well, I shouldn't say a great value. They're my favorite choice typically. But when we talk about value, it's very difficult for me to ignore the value found in pre 65 silver. I've never seen anything like it. So, silver in general, I think it's just important to get into it now. I think it's really just beginning to get noticed, and the public's been out of this market completely. This is all being driven by big money. Wait till the public jumps in, and it's like adding a turbo boost to an already strong market with momentum. So whether you're buying Eagles or pre 65 or Maples or bars, it doesn't matter what you're buying. You just get something while you can if you don't own any. And I will tell you, I've never seen an environment like this where the biggest money in the world is buying it hand over fist, and it hasn't translated yet into the retail market as the public is enamored with equities, as evidenced by their all-time highest position in equities, mom and pop retail, all-time highest position in margin debt at 1.5 trillion, nearly an all-time high in options exposure. So the public is all in on leverage and speculation, as the big smart money has been draining the COMEX, and it hasn't spilled over to the retail market. This is great value everywhere.
So if someone had like a product they don't want at the moment, or they want to get into something different, let's say they had some kilo silver bars or 100-ounce silver bars, and they see the value that's coming out of like constitutional junk silver right now. Do you guys ever do any kind of a trade type of a setup?
Absolutely. We can do that for you. And if you're trading silver for silver, one of the things that we will do is use the same spot price. We don't use bid and ask. So we'll use the same spot price, which will save you. Right now, the difference between bid and ask is roughly 12 to 15 cents. We'll use the same spot to buy and to sell. And yeah, you could trade kilos into silver eagles or whatever you want. I don't know that I would recommend it. The one thing, if you're going to trade right now a bar into coinage, if you do it into pre 65, you'll probably walk away with more silver, or real damn close to it anyway. And that's a better trade for me. Albeit if someone really wants silver eagles, we can do that trade. It's not a problem at all. We'll help everyone, whoever's doing it, we'll help them get it back. We'll send them a FedEx air bill.
Okay.
They'll ship it back to us, and we'll turn around and ship the metal back to them.
So thanks for taking a few minutes out just in the middle here, because I know.
And remember, people want to send us an email at info@Miles Franklin. Don't look at the prices on the website. Request the price list.
Throw this down here.
Reach out to us with questions, and let them know that you saw us on the Surfer stream or video, or whatever you want to call it, live stream or video, because it's very important that we know that. Make sure that you're getting the proper prices and the proper service. And if you just want the price list, that's fine. If you want to be contacted, let us know.
And just to add to you guys, look, we're doing these shows for information, to help you guys get the information out there in the community. Andy is an option, okay? And he's been a great option for myself, for my family, for my parents. And so, I always recommend having many people that you get to know, build a community, understand what products they have, get to know people. It's about relationships. And one of the things I love about Miles Franklin is you're talking to a person, whether it's through a phone call or it's an email or a text message. You're not just going to a site, picking things, putting it in a shopping cart, and then hoping, everything goes well. You got someone you can bounce ideas off of, which is always good. So Andy, kind of continuing off of that, GSR, we've seen some interesting things happen just in the last 24 months. Okay. We've seen the GSR, I think it was around 80, it dipped back down to 70, and then we saw it go up to about 106 or so. And now we've seen it slowly come down to 90, and then slowly down to 80. Once we hit 80, we started seeing it drop very quickly down into the 60s. Kind of high there. But a lot of people are trying to figure out, okay, are we going to be going to 30 anytime soon? How could we ever get back to an 8 or a 12 ratio? Is that even possible? And I think the other part of that question is, will there ever be an opportunity where we'll see it go back up to 80 or 90 or even higher? What are your thoughts on that? And I know you've helped clients in the past play the GSR a little bit, and a lot of people have questions around how to do that and make sure that they're not getting burned. And like we talked about on our last video, one of my friends is like, hey, once it hits 70, I'm going to start moving 10% of my portfolio. After watching the last video, he understood things a little bit more, and he's starting to rethink some of his strategy.
Yeah, 70 is way too. 70 is still abnormally high historically. It's at just about 67, 68 right now. The average of the past 100 plus years since the Industrial Revolution, man's ratio has been about 45 to 1, right in that neighborhood. For most of the people who have bought 45 to 1 would represent at least a double, because it's been abnormally skewed for the past several years. Going back to 2020, it hit 125 to 1, the all-time high. Remember, the first video I did was with Bix Weir in 2010, and we were talking about how it had hit 85 to 1. It was like the second time in human history it had ever been that high. So I went on that show with him and told people, if you own gold, sell it. I'll sell it to the marketplace at an 85 to 1 ratio to silver. You can turn around and get roughly 85 ounces of silver. Now it would depend upon what kind of gold and what kind of silver, but in general, 85 to 1. So you get 85 ounces for every ounce of silver. Now remember, for 5,000, for every ounce of gold, for 5,000 years, the geologic ratio has been 16 to 1. And you go back through history, you'll see that even Isaac Newton made the currency in the mint in Great Britain 16 to 1, 16 silver to 1 gold. That had been the geological ratio forever. Now, man's ratio since the Industrial Revolution has been on average about 45 to 1, and that was because gold was money and silver was industrial. The manipulation of the silver market, largely, I believe, by the Western military industrial complex to make high-tech weapons, has really skewed things. And when you mess with Mother Nature, she gets her vengeance, and she will. Going back to that video I did with Bix, now remember, the average has been about 42 to 45 to 1, even though the geologic ratio has been 16 to 1 for 5,000 years. It is now 7 to 1. It's depleting in nature. It's found in nature in a form called epithermal, like your skin is epidermis, very near the surface. Big deposits were found forever ago. Of the 800 plus million ounces mined last year, only about 20% came from companies that actually mine silver. The rest were byproduct companies mining copper, zinc, lead, that kind of stuff. But when Bix and I did that, I told everyone to do it. They would have got 85 ounces of silver in essence for 1 ounce of gold within 7 months. Mid-2011, you had the then previous peak of 1915 gold to the $50 silver. It's 37 to 1. It got even a little lower in that, but you would have only needed 37 ounces of silver to trade back into 1 ounce of gold, making over twice what you started with. And that is just reaching pretty much the 200-year average. At 42 to 1, you're still 6 times higher than it's coming out of the ground at. Keith Neumeyer will tell you it's 7 to 1 right now, that it is depleting, absolutely. And I believe it. And so when you talk about the trade of a generation, look, if all of you people who have bought in the 80s, as most people have who've bought in the last 5 years or higher, if all that were to happen was it were to reach its 200-year average, 150-year average, it's a double when you switch back into gold. And that would still be 6 times higher than it's coming out of the ground at. So in theory, yeah, I mean, a double is just reaching the average of the last 100 plus years. To expect it to go into a much lower range, 30s, 20s, I mean, it's realistic. It's possible. Don't know how fast it happens, or, no one knows the future, but simply to say it at 20 to 1, look, in biblical times, it was 1 to 1 value. But with the geological ratio or the geological footprint of silver depleting the way that it is, and the demand accentuating the way that it is, at some point the mining ratio has to come into play. So, yeah, I would definitely say 70-1 is way too high to be doing this, and um, 40-1 ish. It's a double for most people. That's when I would start doing it, when it hits the 40s, and there's a high probability that it will. Look, the further away you get from historical averages, the greater the magneticism that returns you to the mean. It's like driving in Death Valley in July. If it's snowing, you're not going to, pull out some cross country skis. It's an anomaly, and probably in 30 minutes, it's all going to melt. And it's going to be 120 degrees.
Yep.
Well, the same thing is true here. This is way, way, way an anomaly in terms of geological and historical price relationships. So, in an IRA, it's the best way to do it. You have no tax implications. Outside of an IRA, it's not quite as good because you do have the tax issue. Now, there's no dealer reporting requirements, but nonetheless, it is selling apples to buy bananas. So as far as taxes would be concerned, you would have to keep that in mind as a potential, something to keep in mind when you're doing this, so that you don't get caught up on that.
Yeah, I think that's always important. And if you guys have CPAs, I would definitely run some of those ideas past them, just so you understand the ramifications of it. Andy, what do you say to the people that, I'll get comments from time to time about, so this is kind of a convoluted question a little bit. It's maybe two thoughts. One is they'll just start mining more silver. Okay, you've just addressed some of that. They're just going to spin up more mines. My understanding is it takes anywhere from 5 to 10 years to spin up a mine. If it's completely from brand new, it can take up to 10 years. But that's still assuming that we have the places to even do it still, right? That there's even deposits and locations where we can just readily tap into that.
Well, if you see only 20% coming from major miners, that should be all you need to know. That
A lot of people
silver deposits are impossible to find. The big ones, I don't know when there's ever been recently a big silver deposit discovered. It is largely a byproduct metal of mining other metals, and have Keith Neumeyer on your show. He'll tell you that real quick. He's the CEO of First Majestic. They are the purest silver play on the market, and they only represent about 60% of what they mine being silver. They do gold and other things too that they mine, but it is an asset that is literally depleting in nature, and it's we've had between a 200 and 300 million ounce shortfall every year for this will be the 6th year in a row.
Yep.
of demand outpacing supply, and that 200 to 300 million ounces also takes into account recycling, what little bit of recycling there is, and the byproduct mining. So if you were just to use the silver mining companies, they only mine about 200 million ounces a year, and where the world is asking for a billion ounces more than that. So it's an asset that is falling off in terms of its footprint geologically, and its uses are accelerating in digital, green, solar panels, photovoltaic, military applications, even monetary applications. Now it's being used as collateral in India. And, I think the realization by nations is that it's worth a lot more than the dollars that are used to purchase it or to try and describe its value. So, yeah, I think it's one of these deals where they can't just go mine more because there isn't the silver to be found. Even if you did, to your point, from drilling and discovery to permitting, which takes forever, to infrastructure, to actually digging the hole, pulling it out, finding it, pulling it out, refining it. Yeah, you're talking years and years and years. So that is one of the byproducts of a market that has been suppressed lower forever, where it killed incentive to mine. Prices were too low. And so we do have an issue as it pertains to any new mines coming online anytime soon. And exploration has been next to nothing in the silver market. So one of these deals where I just think you have to think differently, that this time it is different. It's different because this is a geopolitical deal now. This is not about a market that was trapped by the Hunt brothers with leverage because they realized that there were more paper than bars. Similar situation here in terms of more paper than bars, but the difference is this is geopolitical. You have the United States who says, no, this is now a critical mineral. You have China saying, we agree and we're going to curtail all exports effective January 1st in less than 2 weeks. They're the state refine 70% of the world's silver and send a lot of it westward over the years. Now they're not. And the European Union did it at the end of 23. They labeled it a critical mineral. So, and now you have countries and sovereign wealth funds and very sophisticated global traders that are standing for delivery in London and the US that never did. And they're like, yeah, we don't want paper settlement. Thank you. I know you'll give us a premium, but no, we're going to just stand for delivery. And that's what you're seeing every single month. We see massive deliveries into COMEX, and a lot of it is leaving the COMEX altogether, like the 16.6 million ounces JPMorgan said bye-bye to, and that ain't coming back.
You've got David Bateman too, that had a lot delivered last year, yeah.
Yeah, so it's one of these deals where I think it is different.
I think so too. So Andy, let's shift gears just a little bit. Let's talk about the Fed for a minute here. We've had rate cuts. The Fed came out more dovish than I think most people anticipated based on how low markets were prior to the Fed coming out and speaking. We've got another Fed meeting coming up in January. We've been told that quantitative tightening has ended, and we're starting to see signs that quantitative easing is starting. They're not being super loud about it right now, but we're hearing about bonds being purchased now directly by the Fed. We're hearing
40
about
billion a month, I heard.
Yep, a lot. We're hearing that Japan's in trouble. The Japanese carry trade's having issues. And so we're potentially going to see a lot of bonds coming from Japan. We've got the EU threatening to basically dump a bunch of T-bills as well because they don't want us to pull out of NATO. They don't want us to pull out of the Ukrainian-Russian war, which supposedly we're not in, but we're definitely supplying them. And then you've got the BRICS nations that you've talked about in the past with Operation Sandman potentially happening. So one, I'm not saying this is happening all at once, but I am seeing a trend here. I am seeing, kind of a few different groups of people bullying up against us potentially. What could that do for the price of gold and silver? And I want to couple this with another question, which is a lot of people will tell me that when we get to $100 silver, or if we get to $500 silver, that it's the way that they phrase their question. It makes me believe that they only see price going up for metals because of inflation. They never see it going up because of demand or because it's being remonetized, or it's going from just industrial to a monetization type of a vehicle.
I think both will be in play this time. I think you'll get an awakening. I mean, let's talk about, the inflation may wake the public up. For years, the last decade or so, the U.S. has funded itself by borrowing short term. Janet Yellen wanted to move everything from long term to short term to keep the federal funds rate low. And that made it easy for Congress to run huge deficits without feeling the, immediate pain. And now you add the Genius Act, which by tying money flows to stablecoins backed by short-term treasuries, again, it's creating artificial demand for the short end of the government debt. The reason I say this is that the interest rates aren't set by markets anymore. They're set by policy and financial engineering. The financial engineering being the Genius Act, which goes into effect no later than January 18th, 2027. It says by 18 months after enactment, which was July 18th, 2025, or 120 days after federal regulators issue final implementing regulations. In other words, law could begin applying as soon as early 2026 or by January 2027 at the latest. Anyways, what I'm getting at is that when you hold down rates, whether it be by selling short-term debt and switching long-term debt, to which is normally the way it was, but no one wants to hold our long-term treasuries because of our inflationary agenda and our sanctions, so they buy short-term. But when you hold rates down, the pressure doesn't vanish, right? The inflation pressure doesn't vanish. When you suppress interest rates, you're killing the canary, because as inflation runs, the rates should go higher to compensate for it. So when you bring in the Genius Act, which again will synthetically lower rates, it's not the that pressure has to show up somewhere else. And it shows up not in higher yields because they're being engineered lower. It shows up in higher prices. Inflation becomes the release valve. And that's what you will see as inflation begins to run much, much, much hotter. I think you'll get an awakening by the mainstream. But at the same time, you're beginning to see countries around the globe race for this stuff. And when you see traders here in the United States, it was one thing for me to say on your show that the central banks have been doing this forever, for the last 7, 6 years, which they have. And I've always said they're the most well-informed and well-funded traders in the globe. Now you bring into the most sophisticated traders on Wall Street, and it's a whole nother strata. And again, I'll say it again. These people do not bring in billions upon billions upon billions upon billions every month just for shits and giggles. They know where things are going. And that's why the most sophisticated traders in the world are also the most well-informed traders in the world. So there will be inflation, and inflation is going to be a byproduct of the social engineering of keeping interest rates low through the Genius Act and our fiscal irresponsibility, where we are still adding $1 trillion in debt roughly every 100 days, 600 billion in the 6 weeks that the government was closed. These are unsustainable numbers, especially as AI rips into jobs and the manufacturing. What manufacturing? That's what I've been talking about, why they want to debase the dollar, part of the reason. And you do that by letting the dollar go through inflation, but also by letting gold go to the moon. And that's what they want to do to reshore manufacturing. We've talked about this and how gold, they have a plan for gold to the back end of the treasury and all of those things. But the bottom line is that the question is right on both accounts. Inflation will wake the public up. I think it will get bad enough where the public will have no choice but to wake up to alternatives to traditional assets, certainly to anything fixed income. And at the same time, there is policy change. Silver is now a critical mineral. Gold is now becoming part of monetary policy. You can see it around the globe, and if Judy Shelton is right, you'll see it here very soon too. I don't know. I think both questions are astute, and both questions will be right. Maybe not in unison. Maybe one will lead the way. But my guess is it will be inflation that wakes up the public to maybe have them start to dip a toe into the water instead of the people listening to us.
I think so too. And I've had Kevin Wadsworth from Northstar Bad Charts on.
They have great charts, by the way. Some of the best I've ever seen.
They've got some of the best charts. And one of the things he's showing is this capital rotation. And so, one of the things that's different this time is we've got Bitcoin that's been around. It's
down like 6% in that chart, isn't it? I saw that chart.
And so it looks like money's starting to come out of Bitcoin into gold, maybe into silver as well, and then also from equities into it. And, if the halving cycle continues to play out, it's about every 4 years, maybe it goes a little bit longer this year. That's something new that we haven't seen in the market since Bitcoin's been around. Is will we see a big rotation of money into gold and silver from Bitcoin and also from the equities? And so I've got a video on that. You guys can see where it goes into that with Kevin. But I think all of these things paint a picture, and the picture that I'm seeing is kind of the baseball analogy. I think I probably got that from you, Andy. You had so much great baseball, baseballs behind you and baseball cards and everything. To me, it looks like we're in that first inning of the silver World Series. And that we're also maybe in the top of the second or the bottom of the third, inning for gold. And maybe we're still even earlier than that. What are your thoughts there? How much of a run do you see happening here? Are people too late to get into it, or is now just the right time as people are starting to wake up?
Yeah, and I just texted you that chart you were talking about. No, I think we're still very early. I mean, again, the public has zero, and I mean zero, exposure to this market right now. So I think we are very early. Yes, it would have been better if people had been listening to us a year ago, But I think from a standpoint of capital rotation, from a standpoint of policy, from a standpoint of the public participation, we're very early. The only way to protect yourself in the unknown here is to cost average, of course, and to slowly dip your toe into it. Now, if you don't have any exposure at all, you may not have that luxury. But I would say, yeah, this market is still top of second inning, maybe bottom second inning. We're a long ways from this being considered anything other. Look, when it started to get interesting to me was a month ago when the chief investment officer of Morgan Stanley said, sell half your bonds and buy gold with it. And
Yep.
Michael Hartnett said, no, make it 25% instead of 20%. So you're beginning to see the mainstream and the Wall Street people talk about it. But this is brand new. So, yes, I know it's scary. But look, why don't people feel that way about buying the Dow Jones at 40,000 or buying Bitcoin at 80,000 or whatever it may be? They pigeonhole gold and silver into this. Oh, it's too expensive. I missed the run. Yet they're two of the only assets that have never been allowed to fully find price discovery because of the Western suppression. They kept gold down because of something called Gibson's paradox, which is the inverse relationship between real interest rates and gold. If you manipulate interest rates, you kill the canary. That's gold. Naked shorted all over the place on the COMEX. That's what all the Western banks did. Keep it low, keep everyone in dollars and in pounds and in francs and in Deutschmark and in euro. I mean, on and on and on. And they kept silver down because the military industrial complex needs it in order to make high-tech weapons. Not even about the price. The silver's inelastic a little bit in a big item. They don't care about the price. It's more along the lines of if people knew how scarce it was and its price was a reflection of that, then it would be much harder to source it. You're beginning to see that right now, as there are traders around the globe that have become as sophisticated as those manipulators in the West, and they're beating them at their own game, standing for delivery. So the real moves have yet to even take place. So I wouldn't wait a whole lot longer if I wanted to add a position. But once you add your core position, then you have the luxury of being able to cost average and add at your leisure whenever you get a pullback. Buy the dips, sell the rips kind of thing. You don't need to sell anything, but buy the dips, and I think that's how you'll get ahead in this game.
I agree, Andy. And to me, it's I want to be like a central bank to a degree where they're pulling the metals off the market. And
Yes.
they're using fiat dollars, which is just a piece of paper. A $1 bill has no real value different from a $100 bill. It's cost the same amount to make it. The paper is worth exactly the same amount of money. But why not take those while you can right now and convert those into something that's going to have real value that if you need to convert back into a currency, you always can.
Totally.
And so that's really been my motto this year is dollar cost averaging, accumulation. Prices are going to go up and down, and sometimes we're going to have consolidations, and then we'll have breakouts. But from what I can tell, the momentum's telling me that breakouts are going to be up. They're not going to be down, and we're seeing something that's quite a bit different. Well, Andy, I want to thank you for coming on today, and we'll have you on again soon. And for everybody else, thank you for watching, and please share this with your friends and family.